It's investors bracing for the CPI inflation data tomorrow. Joining us right now for that is Liz Young, head of investment strategy at SoFi. Good morning to you. What is your expectation, and what are you doing about it, or what would you suggest investors do about it beforehand or after?
Well, look, we started the year with this huge burst of risk-on activity. And if you look at just the patterns that have happened since January 1st, the top three sectors in the S&P are those really growthy ones: consumer discretionary, tech, and communications. So largely, this has been a rate-driven rally, and it's been a rally based on the idea that, yes, inflation is coming down. It's coming down relatively smoothly. But I think it also assumes that it's going to keep coming down at that rate. And I think there's also this sort of underlying assumption that Jerome Powell declared victory on inflation in some ways in the last press conference and in some of his comments afterwards. I don't think that's actually the case. So the risk here is that inflation, particularly services inflation, gets sort of stuck at an elevated level. And what I think we're going to start seeing is that we've obviously seen goods inflation come down considerably, and we'll go into likely outright deflation in goods this year. But there's not a lot left to offset that services inflation in the headline number. So as we've expected this to come down considerably each reading, we may sort of slow down the pace of reduction, which I think the market is going to have to grapple with after this big rally.
Fair enough. Why do you think the market, I mean, it sounds like you think inflation is going to be hotter. The market has been glass half full pretty much throughout, and you think they're overthinking that? Or maybe not overthinking that. Maybe they're underthinking it, is what you're saying.
I mean, there's optimism in the market, right? And you have to respect the tape. I think there's been a lot of people on the network saying that of late. I've been definitely on the more cautious side, simply for the reason that there's a lot of indicators still that are pointing us towards there being risk to the downside on valuations. And the idea that, yes, the hiking cycle is maturing and we're probably getting closer to the end, it's not over yet. And the market rarely bottoms before we've kind of completed that scenario. So I would still urge investors to look at valuations and be cautious going into maybe the end of this cycle, especially because I think the end of it is going to be quite prolonged, and it may last a lot longer through all of 2023 than any of us expected. So you have to be careful with declaring victory and assuming that we're entering a new bull market. New bull markets don't typically start around 18 times forward earnings.
How do you think about cash these days, or just buying the 2-year? I mean, does that seem like a better bet than just about anything else right now?
I mean, it's sort of a boring thing to say, but yes, I do think that that's a good place to be, especially if you're going to be on the Treasury curve. I would stop short of saying this is a good time to just buy bonds broadly. You have to look at the difference between Treasury bonds and corporate bonds. I think that the spreads in corporate bonds are still far too tight, and they're really following what's happening in the equity market. But I would, if I had to position myself on the curve, I would position myself on the shorter end of the curve. I think that there's a little bit of upside risk in long yields right now, because if inflation does come in a little bit higher than people expect, or if it stays stickier for longer, you're probably going to see a rise in the long end as inflation expectations start to go up a little bit. So, you know, cash is an asset class again. If you had to buy a defensive sector in the equity market, I would go with utilities or healthcare.
But what about